Here is a statistic that should make every working American stop and think. The top 20% of earners accounted for a record-breaking 57% of all consumer spending through the first half of 2025, the highest concentration of spending power among the wealthy ever recorded. Meanwhile, the bottom 80% struggled to make ends meet. 57% of all spending, from 20% of earners, in the wealthiest nation on earth. And right now, in 2026, with $4 plus dollar gas, 3.3% inflation, record low consumer sentiment, and a Federal Reserve that just held rates for the third consecutive meeting, that divide is not closing, it is widening. The economy that stock market headlines describe, resilient, growing, record corporate profits, is real. And the economy that 80% of Americans are living in, squeezed, stressed, drowning in debt, is also real. They are not the same economy. Today, I am going to prove it with data, explain exactly why it is happening, show you what it means for where the economy goes from here, and give you the specific financial moves that help you build toward the top 20%, or at minimum, stop sliding further down. Let me lay out the full picture with the actual numbers, because once you see both sets of data side by side, the divide becomes impossible to ignore. The stock market is near all-time highs. The S&P 500 has recovered from its Iran war lows and sits above 7,000. Big tech, Microsoft, Meta, Amazon, Alphabet, just reported strong Q1 2026 earnings, with AI investment accelerating. Luxury goods sales are at record levels. High-end real estate in major markets is appreciating. Private jet bookings are at all-time records. JP Morgan Global Research estimates AI is driving above-trend earnings growth of 13 to 15% for at least the next 2 years for major tech companies. For Americans with significant investment portfolios, the economy looks and feels fine, maybe even great. Employment slowed to the weakest pace since 2020 and 2025. It was the second worst year for job gains since the global financial crisis in 2009, and those numbers are expected to be revised lower. Consumer confidence dropped to recession levels. Concern about both inflation and the labor market moved up in tandem for the first time since the 1970s. Inflation is a regressive tax. It hits low and middle-income households the hardest. An estimated 20 million Americans are seeing their health insurance premiums roughly double starting in January 2026 as a result of the decrease in ACA subsidies. Not increase by 10%, double, for 20 million families. That is a financial earthquake affecting 1 in 16 Americans, and it barely made the national news. Credit card debt is at record highs. Auto repossessions are at their highest since the financial crisis. 1 in 3 Americans skipped a meal last year to save money, and consumer sentiment, measured by the University of Michigan, just posted its lowest reading in 74 years of recorded history. 2 economies, same country, same year. Understanding why this divide exists is not just academically interesting, it is practically important because it tells you exactly what financial levers move you from one economy toward the other. The fundamental driver of the K-shaped economy is simple. People who own assets, stocks, real estate, businesses, have seen those assets appreciate dramatically over the past decade. People who earn wages have seen those wages rise, but not as fast as assets. When the Fed cuts rates, asset prices go up. When the Fed raises rates to fight inflation, wage earners bear the brunt through higher borrowing costs, while asset owners are partially cushioned by strong equity returns. The concern about both inflation and the labor market moving up simultaneously is reminiscent of the 1970s stagflation era, and it is the economic scenario the Federal Reserve is most poorly equipped to address. Inflation is a regressive tax. It hits low and middle-income households hardest because they spend a higher percentage of their income on necessities, food, gas, utilities, housing, where prices have risen most. AI has not yet significantly impacted aggregate labor market conditions, but small pockets of disruption already exist, including among young workers in AI-exposed occupations such as customer service and computer programming. As firms take time to integrate new technology, historically 20 to 30 years for full adoption, the labor market impacts of AI will gradually intensify. The workers who are currently thriving are those whose skills complement AI, engineers who build it, executives who deploy it, investors who fund it. The workers who are struggling are those whose tasks AI can increasingly replicate: data entry, customer service, basic analysis, routine writing. The divide is not yet massive in the aggregate data, but it is growing. As a result of the decrease in ACA subsidies, an estimated 20 million Americans are seeing their health insurance premiums roughly double starting in January 2026. Healthcare costs are top of mind for voters, with both parties pressing competing visions for reform. For a household earning $50,000 per year, doubling health insurance premiums can consume an additional $4,000 to $8,000 annually, a 10 to 15% effective pay cut that never shows up in wage data. This coming Friday, May 8th, is one of the most important days on the economic calendar. The April jobs report drops at 8:30 a.m. Eastern. And this particular report is more significant than usual because it is the first full month of employment data since the Iran war began in late February. The March jobs report showed 178,000 non-farm payrolls added, a rebound from February's sharp decline. However, the January number was revised up 34,000, while February was revised down 41,000, meaning the combined two-month picture was 7,000 jobs lower than previously reported. The April employment situation will be released Friday, May 8th, 2026 at 8:30 a.m. Eastern. Here's what to watch for in Friday's report and what it means for your money. If payrolls come in above 150,000, the economy is absorbing the Iran shock better than feared. Markets will rally. Rate cut expectations for the June Warsh meeting will remain modest. For you, good news for job security and investment accounts, but don't expect mortgage rate relief. If payrolls come in between 75,000 and 150,000, the economy is slowing but not collapsing. A cautious Fed holds steady. The two-economy narrative continues. Top earners fine, bottom earners stressed. For you, defend your savings, aggressively pay debt, watch your own employment security. If payrolls come in below 75,000, the economy is weakening faster than expected. Rate cut expectations for June surge. Markets may initially rally on cut hopes, but the underlying weakness is bad news for consumer spending and employment. For you, maximum financial defense mode. 6 months of emergency fund becomes non-negotiable. Merrill Lynch's chief investment office expects 2 additional rate cuts in 2026, starting in June, which would bring the Fed's target rate to 3 to 3.25% by year-end. A weak jobs report on Friday, May 8th would validate that forecast and potentially accelerate the cut timeline. We will be covering the April jobs report live on this channel Friday morning the moment it drops. Subscribe and turn on the bell notification right now. There is one more piece of the two-economy story that deserves specific attention, and it is the one that poses the biggest long-term risk to American household financial stability. Federal debt outstanding is poised to eclipse the size of the entire economy for the first time since World War II in 2026. Expansions to tax cuts and upward pressure on spending via Social Security and Medicare will intensify. We have entered the peak years for baby boomers turning 65 and tapping those resources. But the more immediate personal debt crisis is at the household level. Credit card delinquency rates have climbed to the highest level in almost a decade. Auto repossessions over the last 2 years hit levels not seen since the financial crisis. The average credit card APR is above 20%, the highest in the modern era of credit cards. Here is the cruel math that is trapping millions of American households. You carry a $6,000 credit card balance at 22% APR. Every month, you are charged $110 in interest. If you can only afford minimum payments of around $150 per month, only $40 is going to principal. At that rate, paying off $6,000 takes over 20 years and costs you an additional $10,000 in interest. The credit card company has essentially made you a $10,000 loan by doing nothing more than keeping your balance alive. Higher commodity prices are a textbook negative supply shock, raising prices and costs, disrupting supply chains, and eroding purchasing power. These effects may be amplified as firms and workers try to recoup losses, risking wage price spirals, especially where inflation expectations are poorly anchored. When you are spending $110 per month just to service credit card interest, that is $110 that is not going to groceries, not going to savings, not going to your children's education. Every month you carry that balance is a month you stay in the bottom 80% economy. Here's the honest truth about what financially separates the top 20% from the bottom 80%, and the specific moves that build the bridge between them. The single biggest financial differentiator between the top 20% and everyone else is asset ownership. You do not need to be rich to start. A 401k contribution, even $50 per paycheck, is asset ownership. A Roth IRA contribution is asset ownership. Buying index funds through a brokerage account is asset ownership. Start somewhere. The compounding effect over 20 years is extraordinary even on modest contributions. JP Morgan projects above-trend earnings growth of 13 to 15% for major AI-driven companies for at least 2 years. And broad index funds capture that growth automatically for every investor who owns them. As covered above, 20% plus APR credit card debt is the single biggest financial anchor holding people in the bottom 80%. Use the avalanche method. List every debt from highest to lowest interest rate. Attack the highest rate first. Make minimums on everything else. Consider a 0% balance transfer card if your credit qualifies. This one move, eliminating high interest revolving debt, is worth more to your long-term financial trajectory than almost anything else you can do. Without an emergency fund, every unexpected expense, car repair, medical bill, appliance failure, goes directly to a credit card at 20% plus APR. That is the cycle that keeps people financially trapped. 6 months of essential expenses in a high-yield savings account earning 4 to 5% APY is the foundation that makes every other financial move possible. Build this before you invest beyond employer match. AI disruption is concentrated in specific occupations: customer service, data entry, basic programming, routine writing. Workers in these areas face growing automation risk. Workers who understand how to use AI tools, prompt engineering, data analysis, AI-assisted design, are seeing their value increase. Platforms like Coursera, LinkedIn Learning, and even free YouTube tutorials can upskill you in AI tool usage within weeks. The investment of 5 to 10 hours per week in learning AI skills is one of the highest return time investments available right now. With the Fed expecting 2 cuts in 2026, starting potentially in June, the window for 4.5 to 5.0% APY 12-month CDs is closing. If your emergency fund is already built and you have additional cash sitting in a low-yield account, move it to a 12-month CD this week. Guaranteed 4.5 to 5% return on your savings, regardless of what happens to rates after the Warsh era begins. Many have claimed their Social Security benefits early this year for fear of losing benefits later. The Congressional Budget Office just updated its population projections, reduced with the loss in immigration, which brings us closer to the Social Security cliff. Every economic policy decision on Social Security solvency, healthcare costs, tax rates, energy policy flows through Congress and the White House. The 2026 midterms in November will determine which direction the country goes on all of these issues. Being financially informed means being politically engaged. Know the policies, know the candidates, vote. Today's bottom line. The American economy has 2 faces in 2026. The top 20% of earners account for 57% of spending and are largely insulated from the current pressures. The bottom 80% are navigating record credit card debt, doubled health insurance premiums, $4 plus gas, and the weakest job market since 2020. The April jobs report this Friday, May 8th, is the next major signal for which direction this goes. Your moves: own assets, eliminate credit card debt, build your emergency fund, upskill toward AI, lock in a CD this week, and vote in November. Hit like and subscribe for daily coverage. Drop a comment below. Which economy are you living in right now? I read every single response and I want to hear from you directly. See you tomorrow. We are covering the April jobs report live on Friday.